All right, let's get right into it. In this explainer, we're going to go way beyond the headlines of a major company's Q4 earnings. We're talking strategy, risks, and the real story behind one massive number. And there it is, the big one. $5.4 billion in profit, just for the fourth quarter. Now, that's up 6% from last year, and it's the number that's grabbing all the attention. But to really understand what's going on with this company, you've got to look past this one number and see what's actually under the hood. So here's how we're going to do it. We're going to run a full-on health check, investor style. We'll start with the big numbers from Q4, then look at their growth engine, loans. After that, we'll see how they're focusing on efficiency, check their financial foundation, and finally, look ahead to their outlook for 2026. Okay, section 1, the big numbers. Let's crack open that huge profit figure and see what it really means for the people who own the stock. Okay, so forget the total profit for just a second. For investors, the real number to watch is earnings per share, or EPS, and it grew by a whopping 13% compared to last year. This is so important because it means the company isn't just making more money overall, it's getting more profitable for every single share out there, and that is exactly what investors love to see. A 13% jump in EPS is seriously impressive. But the big question is, where did all that growth come from? Let's dig into the company's main business to find out. And the answer is pretty simple. Loans. A ton of them. Their loan balances shot up 5%, not just from last year, but from last quarter, too. In fact, this was their best quarter for loan growth since way back in early 2020. And you know what more loans mean, right? More interest income. That's what's feeding the beast. But here's the twist. The thing that's really pushing this growth, it's not your everyday mortgages or car loans. A huge chunk of it is coming from a super specialized, pretty complex area, lending to other big-time players in the world of finance. So the key to all this is a niche called fund finance. It sounds complicated, but think of it this way. The company is basically playing banker to the bankers. They're giving short-term loans to huge private equity and investment funds so they can jump on deals fast. It's a high-stakes game for sure. And this isn't some wild all-or-nothing bet. As you can see, they're spreading their chips across 4 different areas: lending to asset managers, to other commercial finance firms, to consumer lenders, and to real estate funds. It's a really deliberate strategy to manage their risk, even in this specialized world. Now, I know what you might be thinking. Whoa, that sounds kind of risky. But the company's CFO, they're confident. They said it themselves. They believe this kind of lending offers an attractive risk return, mostly because the loans are backed by solid assets. Okay, so that's the growth story. It's aggressive, it's focused, but that's only half the picture when it comes to profit. Now let's look at the other side, how the company is reining in its costs. And this focus on being efficient, it's not a new fad for them. They have been trimming their headcount every single quarter since the third quarter of 2020. That shows some serious long-term discipline when it comes to running a leaner operation. But getting lean comes with a hefty price tag. We're talking $612 million just in severance costs in Q4. But here's how you have to think about it. This isn't just a cost. It's really an investment they're making upfront to save a whole lot more on salaries and benefits all through 2026. So we've got a company flooring the gas on growth, while at the same time trying to slim down. That's the tricky balancing act. So the big question is their financial foundation strong enough to handle all this pressure? Let's take a look. And you know what? The credit quality looks really, really solid. Their net charge-off ratio, which is basically their prediction for how many loans might go bad, is actually down. And the number of loans already in trouble has also dropped. The takeaway here, they're being smart about who they're lending to, even as they grow fast. So what about their safety cushion? Their main capital ratio, called CET1, is at 10.6%, which is way above the 8.5% that regulators require. Think of this as their financial emergency fund. They're not just scraping by, they have a really healthy buffer, which gives them the power to handle any economic bumps in the road and keep investing in the business. All right, the foundation looks strong, the strategy seems clear, so let's turn to the last piece of this puzzle. What is the company telling us to expect for 2026? Well, the revenue picture looks pretty good. They're expecting net interest income, that's their core moneymaker, to grow from $47.5 billion to around $50 billion in 2026. That's assuming loan growth continues and interest rates behave themselves. But hey, revenue's only one part of the story, right? To get the full picture on profit, we've got to look at their expense forecast. And luckily for us, they laid out a pretty clear roadmap of what they're expecting. Let's actually build their 2026 expense forecast together. It's pretty logical. You start with their 2025 expenses. Then you pull out those big one-time severance costs. Next, you have to add back some costs that naturally go up when revenue goes up. And finally, you layer in some higher regulatory fees and other new investments. And there you have it. That gets us to the final number, a projected expense total of $55.7 billion for 2026. This really shows that while they're saving money in some areas, they are absolutely still spending and reinvesting in other places to keep the growth going. So let's wrap this all up. What's the bottom line? Q4 was a really strong quarter, fueled by some seriously impressive loan growth. At the same time, they're on a major efficiency push, which is all being built on top of a rock-solid financial foundation. And looking ahead, the forecast for 2026 seems to be for steady, controlled growth on both revenue and expenses. And that leaves us with the one big question for 2026. Can this company really walk this tightrope between pushing for aggressive growth and making deep cuts to their costs? Is this dual strategy going to be a masterstroke, or will this shifting economy prove to be too much? That is the story to watch.